Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about a few changes that the ATO have made that is directly targeting property investors as well as sort of general taxpayers. Now, obviously, we want to look for opportunities to reduce tax wherever possible. But by the same token, we want to stay on the ATO's good side, so we certainly don't want to invite an audit. And in respect to tax planning, I strongly believe the best option is always to stick within the black letter of the law. That is, don't transgress into any grey areas unless you've got a really strong position or argument to make, because in the long run, net of fees, hassle, risk and stress, it rarely works out to a taxpayer's advantage, and at best, quite often, typically all you can do is delay tax rather than avoid it completely. Of course, there's things that you can do to minimise tax, but I'm talking about the stuff that gets a little bit more inventive. So be really careful when receiving, say, contentious taxation advice. You know, don't go out of your way to pay a lot of money for those sorts of things. Now, the ATO did a few audits recently, specifically targeting property investors. And as a result of that, what they've done is, back in April, they announced that they would actually double the amount of audits that they did, purely because I suspect they've raised a lot of tax revenue. And in fact, they said that 90% of times they found errors in tax returns. There was 4 main errors, which I'll go through in a second. But what does that tell us? It tells us that not a lot of taxpayers are getting 100% correct. And it also tells us that if you are unlucky enough to be picked for an audit, it's likely that they'll probably find something. So let me talk about the 4 common errors. The first one was interest deductions. And that's not surprising given, it's probably, for most investors, their main deduction from a dollar value perspective. And something that you really should focus a lot on to make sure that you've got the best position possible. And the issues were really mixing of purposes and not being able to demonstrate why interest in respect to a particular loan is deductible. Also getting confused or mixed up with non-deductible debt and including some of that interest as well. So remember, the onus is on you, the taxpayer, to be able to prove to the ATO why you've treated an expense as a tax deduction. And so you've got to be able to demonstrate, here's the loan, here's the interest in respect to that loan, and that loan, by the way, is related to this investment property or these shares or whatever it is. So you have to draw that connection. So just be really careful. Separate loans by purpose. So don't mix, 2 investment property, debt for 2 investment properties in one loan, or a little bit of shares and investment property in one loan. Just separate it by investment purpose and investment asset. And if you're doing a refinance and you restructure some of your loans, so that is, you shift some balance into another loan or combine 2 loans if they're related to the same property, just make sure you keep really good records in respect to that, so that if you're asked to go back 5 years, you can certainly prove it. What I tend to find is that if someone's been audited, if they can answer all the questions for that particular tax year, the ATO typically won't go back to previous years. If they start finding irregularities, mistakes, errors, those sorts of things, then you can bet yourself that they'll go back previous years. So good record keeping is a must here. The second common error was claiming improvements as repairs. So there's 2 things that you can do to a property. You can repair it or you can improve it. Repairing it typically is defined as bringing it back to the condition it was in when you first purchased the property. A repair is improving the asset beyond its original condition or changing the nature of an asset. Repairs are deductible in the year that they're paid for, whereas improvements have to be depreciated over their useful life. There's a bit of guidance and information on the ATO website of what makes an improvement and repair, and it could be a combination of both, by the way. So one particular expense could be part improvement, part repair. Things like painting a property typically would be regarded as a repair. Ripping out an old 1960s kitchen and putting a new one would be typically an improvement. So just by way of a couple of examples there. So it's important that you understand what an expense is classified as, so that it's treated correctly within your tax return. The third error was holiday homes. This is particularly in situations where homes were rented to friends at mates rates, friends and family at rates below market. If holiday houses aren't actually available during peak holiday periods, so if you've got a place down the beach, is it not available over summer? Do you occupy it over summer? If owners are unreasonably refusing tenants, so putting it online but then refusing every application to rent the property on Airbnb or whatever, and whether owners genuinely took steps to find a tenant during the period it was available for let. So again, be able to demonstrate that you have taken steps, advertise it on certain websites, you have a managing agent, etc., etc. So if any of that sort of stuff is happening, that's what the ATO is looking for, and will prorata or reduce or deny outright any tax deductions in relation to that property. So if you do have a holiday home and you do rent it out part of the year and occupy it part of the year, make sure you're getting good quality advice there. And the last error was not being able to substantiate expenses. That means that people didn't have receipts for expenses but claimed the deduction anyway. The best thing to do for property investors, which I always advise my clients to do, is just get the managing agent to pay for all the bills. That's what they're there for. They're there to help administer and run your investment property. And so if you receive a bill and some insurance, a rates notice, even land tax, just email them the bill, ask them to pay it from next month's rent, and therefore they will retain, they will then have to keep the receipts, so they'll be responsible for that. Plus also at the end of the financial year, you'll get a printout of the property's income and expenses over the 12-month period, which you can just give to your accountant. Makes it a lot easier for you to track expenses per property, to see how they're performing from an income perspective and whether there's any problems with a particular property, it's costing you too much money. And also it's going to make it a lot easier for your accountant, but most importantly, you don't take the responsibility for maintaining the receipts, and you make sure you're going to pick up every tax deduction, whereas sometimes if the managing agent is paying some expenses and you're paying some expenses, some expenses could slip between the gaps when it comes to preparing your tax return. So that's just an easy tip that sort of saves you a bit of time. Now, I'd like to talk about one significant change that has occurred from 1 July 2019 this year, and that is that the ATO for the first time is receiving the descriptions that you put in every section, every deduction section. So, the deduction sections are titled or named or numbered D1, D2, D3, and so forth. So, for example, D1 is work-related car expenses, then D2 is work-related travel expenses and those sorts of things. And so normally within each section you might have a number of deductions, and normally what a tax agent would do is go into the return and list those deductions in their software. And so you might have 3 items of $100 each, so your total deduction for D1 is $300. Well, previously all the ATO could see is D1 deduction $300. Now what the ATO will see is they'll see the actual description and itemisation. So it might be, under some different labels, it might be, telephone expenses or internet expenses and those sorts of things. That's going to create a couple of problems. Firstly, the ATO is going to be using artificial intelligence software to crawl through tax returns and identify the taxpayers they'd like to audit. So what they will do is compare your deductions with the average for your occupational rating, and they're obviously going to audit the outliers. If your deductions seem larger or unusual, it's very easy for them to then just automatically generate a audit letter, and that doesn't require any human resource to do that. Secondly, it's important to use the correct descriptions in the correct section. So, for example, don't use generic descriptions like various receipts or general home office expenses in your returns. You're more likely to be flagged if you do that. And then also make sure you're claiming the right expense under the right labels. For example, parking and tolls should be recorded under D2, which is work-related travel expenses, rather than D1, which is work-related car expenses. It might seem a bit finicky, but now that they're getting all this extra information and they're going to be able to use that data to compare amongst other taxpayers, you want to make sure everything is the right box and that you're using the right descriptions so that you're not inadvertently flagging yourself. Of course, what I would be saying is just get a tax agent to do all the work for you, and you don't need to take that risk. Also, what the ATO is doing is, as part of its sort of data mining program, is it's automatically generating letters or sending out letters to taxpayers and asking them to get a letter from their employer to verify that their work-related deductions. So, for example, if you've claimed car expenses, what they'll ask you to do is ask you to get a letter from your employer confirming how you are required to use your vehicle in the course of carrying out your employment duties. So again, just be really careful with how you're treating deductions and whether they're appropriate and what sort of risks you're exposing yourself, because that sort of data matching is going to, I think, cause some headaches for some taxpayers. Similarly, things like mobile phone expenses and internet access. Again, if you want to claim internet for your in your tax return, you have to, that's related to your employment, you're going to have to get a letter from your employer saying that they require you to have internet access at work, and or maintain a logbook for 4 weeks of the year, logging all your usage of internet usage, which is personal and which is not. Good luck with that. I doubt anyone's really doing that at the moment, so then just be really careful about what you're doing there. And remember, you, the taxpayer, carries all the risk. So that is that you have to sign off the tax return, and as long as your tax agent hasn't been negligent in providing their professional services, then you ultimately are going to have to pay the tax and interest and so forth. So let's talk about that for a second. If you do get an audit and if some deductions are going to be denied, then what the ATO will do is reissue an assessment notice, which means that you'll crystallise a larger tax bill that you'll have to pay, and you could pay interest and or penalties in relation to that. So the interest is what's called shortfall charge interest, which is about 4.5% at the moment, so that's pretty straightforward. The penalties that they could charge will depend on depending on your circumstances. So they'll charge you 25% if you failed to take reasonable care, or that's what they determined, failed to take reasonable care. If they deem you've been reckless, then they'll charge you 50% penalties, and intentionally disregard the law, 75%. So whatever tax you owe them, times 25, 50, and 75%. So, if you've been certainly reckless, you'll end up paying 50% more tax at the end of the day. Now, if you do receive a audit letter, what should you do? Well, in my opinion, you should go straight to your registered tax agent and let them deal with it. Because it's really important that information's provided on a timely basis, that the information that you have provided is accurate and correct and reconciles with the tax return, and that you don't want to provide any more information than you have to. So that is, if sometimes you provide too much information, it might create too many questions. So it's really important to know what to provide and when to provide it. You can get tax audit insurance, so which wouldn't be really probably appropriate for most individuals, but if you're in business and you're worried about the expense of a tax audit, where you can get it's not very expensive, get some insurance against that. So what can you learn from all this information? Well, really, I think start talking to your tax agent and really make sure your record keeping is robust enough to deal with all these matters. So if there are some changes in the way or some expenses that you want to claim, in this tax year, so the tax year ending June 2020, then at least speak to your tax agent and work out what information and how you need to structure your finances so that you're going to be able to make that claim, rather than leave it to the end of the financial year and then realise, well, I should have kept those receipts, I should have paid that in a different way, should have kept the logbook or something along those lines. The ATO's digital tools and information is greatly enhanced each year. They get a feed from the state revenue officers, the title officers. They know when you've sold properties, when you've purchased properties, all those sorts of things. This is all very new stuff that's only happened over the last couple of years. Previously, the government agencies kind of worked in silos and really didn't share a lot of information. But with the digital age, it's a lot easier. They've now got big data, and they can really use that forces for evil rather than good. So it's even more important as each year passes to make sure that you're well on top of your taxation matters and that you're conducting yourself in a professional manner so that you're not putting any deductions at risk. Ultimately, you want to reduce tax in a legal way, and you want to make sure that you're doing that in a robust way as well. So if you do get an audit, it's not going to cause you too many problems. So that's it for this week, all about the ATO. As always, there's a bunch of links in the show notes and the blog on the website. And as always, if you enjoy the podcast, I do get some feedback and I enjoy receiving it. Please pass it on. Recommend a friend or family member to listen in. The more the merrier. Thanks very much, and talk to you next week.